Mr. Hasdovic's online lecture series, lecture number 8, The Great Crash, or What the Heck Just Happened? Last week we played a game. We simulated the stock market of the 1920s. Whether or not you are aware of it, there are many levels and intricacies in our simulation that closely modeled what actually happened in that decade, the 1920s, that led to the stock market's crash and ultimately to the Great Depression. What we'll be doing in this lecture is looking at what we did and how it compared to what actually happened. And hopefully, you'll see what went wrong in our class and in our country.
October 29th, 1929, Black Tuesday. The New York Stock Exchange is in a panic. Frantic investors have scrambled to unload their stocks at any price. Everyone wants to sell. No one wants to buy. Suddenly, even the most gilt-edged securities are practically valueless. The stock market crash has come, and the Great Depression has begun.
Banks and buying on margin. Perhaps more so than anything else, banks who lent people money to buy stocks on margin were responsible for the problems in the stock market. By lending people, in some cases, more than 90% of the cost of each stock per share, banks floated billions of dollars into stock investments. This is important for two reasons. First, it meant a lot of people were buying stocks with money they didn't have and couldn't pay back immediately if needed. Second, all of this money that was injected into the stock market through credit artificially and rapidly inflated the value of stocks. Look at this chart. You can see how in just 2 years, some companies, and by the way, do they look familiar, rocketed in value, doubling, tripling, or in AF&P's case, increasing nearly 7-fold. These values were artificial because a large portion of these companies' shares were bought with loans, money that people didn't really have, and therefore money that didn't really exist. Like in our game, greed weighed in heavily with the problems that the market had in the 1920s. From the beginning of that decade, it seemed like there was no end to the rise of the market. Millionaires seemed to be made on a daily basis, and for the first time in our country's history, the middle class was becoming heavily invested in the market. The problem with this, just as in our class simulation, was that a great many people had no idea how the market really worked. When people invest money in consistent stocks and bonds over a long period of time, years or even decades, the market can efficiently create a nice profit on your income. However, the practice of day trading, buying and selling enormous shares of stock weekly, daily, or even hourly in order to make a quick profit, created a lot of instability and excitement in the market, just as in our class. When you invest thousands or even millions of dollars in a company's stock, you're injecting a great deal of wealth into that company. But when great amounts of that stock are sold, that company is losing its wealth and value. Just as we saw in the last day and a half of our simulation, when everybody wants to sell, that company becomes quickly, rapidly devalued. Further, there was a great deal of inexperience both in our class and in the 1920s. Did you feel confused? Anxious? How were your math skills? How much did you know about the companies you invested in? How much did you know about how the actual market behaves? If your answers were, in order, yes, yes, not too little, and very little, then you were not unlike many people who were playing in the 1920s. The difference, of course, is that they were playing with real money, billions of dollars that were potential car payments, house payments, college funds, retirement funds. We were just playing for some extra credit. When the stock market crashed on October 29th of 1929, billions of dollars in stock were lost instantly. This meant billions in loans. Within a matter of only 2 weeks, $30 billion in 1929 money were gone. That's $30 billion in companies' money to hire employees and expand production. That's salaries, money for rent, money for food. $6 billion of that money was money that banks had lent on margin. Money those banks would not be getting back. When banks can't collect the money they're owed, they get in big trouble. Just as we've seen over the last year with our own present mortgage crisis, banks repossessed homes, cars, furniture. They couldn't, however, find many people to repurchase these things from them, so the prices for homes, cars, and consumer products dramatically declined. When banks couldn't make their money back, they couldn't compensate people who had deposited their savings within their vaults. In the 1920s, there were two banking rules that didn't exist that do exist now as a direct result of the Great Crash and the Great Depression. In the 1920s, the banks didn't have a reserve requirement, a rule that stated they had to make sure a certain percentage of all their assets were kept in cash within their vaults at all times. Because of this, many banks literally lent out every single dime people saved. When this money was lost, banks had nothing to give back to their customers. The money they'd lost in lending on margin then translated to Mr. and Mrs. America, losing all of their savings. The other rule that didn't exist was more of a protection. Back in the 1920s, banks weren't required to carry insurance. Nowadays, if a bank should lose its assets and it is insured with the federal government through the FDIC, customers can recover up to $250,000 of their savings. And you'll be hearing more about the FDIC in the weeks to come. Now that didn't exist back in the 1920s. When banks lost their money, they lost yours, and that was, in the case of thousands of banks by 1932, gone forever, as banks closed their doors forever. Agriculture. Bank and investor issues, while the chief cause of the crash and the depression, weren't the only culprits, however. Farmers were in deep trouble during the 1920s. Many of the problems that the populists were rallying against in the late 1800s were starting to come to fruition. Technology, which had revolutionized industry in cities, was having a similar effect on farms. Thanks to powered tractors, threshers, harvesting equipment, and planting equipment, farmers could plant more crops faster and reach larger, healthier harvests than ever before. This came with some hefty negative consequences, however. Because more crops were being produced at a faster rate, crop prices began dropping dramatically during the 1920s. So much so that just as farmers were pulling in larger and larger harvests, they were also earning less and less money. Farmers had to borrow money season after season just to stay afloat. Populists had called for a federal regulation of crop prices as well as subsidization, paying farmers a base level income from the federal treasury that would guarantee that no matter how low prices fell, they would still make enough of a profit to keep them producing and out of debt. But these cries fell on deaf ears on the numerous Republican administrations during the first 3 decades of the 20s, who believed that the less government involvement, the better for business. As farm mechanization increased, fewer farm hands were needed. This created a bit of a boom in unemployed farm workers, an early hint at the massive unemployment that would come when industry would be likewise affected in the 1930s. When the crash hit and banks quickly began calling in on all the loans they were owed, many farmers couldn't pay and as a result lost their land. Prices for crops were so low in the late 1920s and the 1930s, in some cases it was actually cheaper to not grow a crop than to pay all the costs involved in planting, growing, harvesting, and sending it to market. By early 1930, thousands of farms were repossessed, tens of thousands of farmers thrown off their land, and millions of acres of farmland, especially in the Midwest, lay fallow, empty and unplanted, as banks couldn't find any buyers for this land. This was a situation begging for disaster. The Midwest typically has hot, dry summers. Without crops holding the soil together, it would quickly dry up to dust. All that was needed were windstorms. And what have we learned about wind in the Midwest?